We've been working on some basics of financial management up to this point. We've talked about balance sheets and income statements. We've talked about basic ways to analyze those and figure out more what's going on with the company. And then we talked about this idea of the time value of money and investors' required rate of return. That required rate of return is an important concept that'll carry us most of the way, if not all of the way through the semester, and the idea of present value and future value, right? Taking an amount today, the present value, and compounding it into the future, or an amount in the future and discounting it back to today. And remembering that our discussion that the investor's required rate of return will include interest, inflation, and some measure of risk. For now, we're leaving aside everything except interest. So for now, when I say required rate of return, what I mean is the interest rate we're compounding or discounting. That will not be the case for the entire semester, but for now. Now we're going to put those things together and do some and start talking about something that also will take us through most of the rest of the semester. I mean, that's something that I think you'll find out about this class is that we end up doing the same thing over and over. For different situations, and it looks a little different, but basically we're going to do the same thing over and over. And that thing is making investment decisions. Now, this is not an investment class, and we're not going to get into portfolio management and options and trading strategies. None of that. None of that. We're talking about the very basic concepts of investment decisions. And the way we're going to make those investment decisions is we're going to compare the value of an asset that we're considering to its price. And that's what we're going to do for most of the rest of the semester, is we're going to make investment decisions based on comparing value to price. And the idea being, if the value is greater than the price, we should invest. But if the value is less than the price, we should not invest. Okay? All right. Now, price for us in this class, in this context, price for us is provided by the market, right? If you want to know the price of some investment, some asset, you go to the market to find out. Now, that's the market in a broad sense. The market is any place that buyers and sellers come together, right? It could be the grocery store. It could be a used car lot. It could be the stock market. Any place that buyers and sellers come together and settle on a price. Right now, for us, for most people, I shouldn't speak for you, but for most of us, the price that the market gives us is the price we have to pay. Now, in most situations, the price is given to us by the market, and we have to pay it or not. Right? Most people don't have, in most situations, most people don't have the power to force prices to change. Right? In macroeconomics, we call that market power. Most of us don't have market power. Right? Bill Gates probably has market power, but you and I shouldn't speak about you. I don't have market power. So whatever the market tells me the price is, that's what I have to take and pay it, or don't. Value, on the other hand, value is an individual assessment, isn't it? Value is something, that each one of us decides for him, her, their self. There's no one to tell us what the value is. We must decide that on our own. And when we do decide that, then we can compare our personal assessment of value to the market provided price and make a decision. And again, if our estimate of value is greater than the price, that basically tells us that whatever it is we're looking at is worth more than it costs price. And we should invest in it. On the other hand, if our individual assessment of value is less than the price, that basically tells us that it's worth less than it costs. It costs more than it's worth, and we will not invest. Right now, you may be thinking, now, I buy things all the time, and I never think about that. Well, I would argue that we do think about that. We just don't call it that. Right? Imagine if you were online, I don't know, in Amazon, looking for a sweater, right? Looking for a nice cashmere sweater. I don't know, for yourself as a gift, a nice cashmere sweater. And you're scrolling along and you find the sweater and you like the color, you like the way it's made, you like everything about it. You think that's really, really nice. Until you scroll down and you find out that it costs $250. And you say, whoa, that's way too expensive. I can't do that. Well, what just happened? Well, what just happened was you took that $250 price provided to us by the market, in this case, Amazon, the market, and compared it to your internal assessment of value. Now, you may not have actually gone through and said, well, the value of that is X dollars. But what you did do is say, the value of that is less than the $250. Right? So you have compared value and price, and you decided that the price was much higher than my estimate of value. I'm not going to invest. That's the kind of investment decisions that we're going to be talking about. Now, it's worth noting that somebody else may navigate there to Amazon and come up to that very same cashmere sweater, find the price of $250 and say, well, that's not bad. I'll buy it. Well, what happened there? Well, that person's estimate of value was more than the 200. It only costs 250. It's worth way more than that. I'll buy it. Right? So you see that again, what happened here was that comparison of value that each of us decides for ourselves and compare it to the price that the market provides us. And that's how we're going to do investment decisions. And that's going to take us through most of the semester, most of the rest of the semester. All right. So to begin with, from now until midterm, we're going to be doing that for the investments, the assets that appear in a company's capital. And we're going to be looking at it from the viewpoint of an outside investor looking at the company and deciding whether or not to buy one of the assets included in the company's capital. Now, when we finish that, then we're going to turn it around and we're going to look at it from the company's view and make decisions about which assets the company should invest in. Right? But we're going to start with capital and outside investors. And every time Every time, every decision is going to be made the same way, comparing value to price. Now, price, that's easy. The market tells us that. Amazon told us $250. The price is given to us by the market. And as I said, most people don't have market power. So that's the price. Now, the trickier thing is going to be, how do we estimate value? Because remember, value is an individual thing, a person by person thing. All right, let's leave that question aside for a moment. And before we jump into this, let's remind ourselves what we mean by capital. I think I've mentioned it somewhere along the way, but only in passing. So let's talk about capital for a minute. I didn't provide you with this handout, but you've seen it before. It's a comparative balance sheet, so I'm going to share it now. This is a comparative balance sheet here in the upper left-hand corner that you have seen before. We used it to talk about common size statements early on. Okay, assets, liabilities, and equity. And these last 5 accounts, those are capital. Long-term debt, preferred stock, common stock, and paid-in capital, because remember, those are 2 parts of the same thing, and retained earnings. Those are what we're going to call the company's capital. And when to start out, we're going to make investment decisions, talk about making investment decisions for each kind of capital. Okay, now let's think back a little bit about what we talked about balance sheets early on. And remember that we have the current part of the balance sheet, the short term, current assets, current liabilities. And then we have the long term, or the fixed or the permanent part, fixed assets and capital. The current asset, current liability part, that tends to be day-to-day operations, right? Those accounts increase and decrease pretty much just as a result of day-to-day operations. We sell our product, we get cash, or we sell it and we get accounts receivable, the customer pays, the account receivable becomes cash, and so on and so on. From now on, we're going to be dealing with the permanent or the fixed part of it. And these things do not change as a result of just day-to-day operations. Right? First of all, remember that balance sheets are on historic cost and not current market value. So even though the value of our fixed assets, the property, the equipment, even though that fluctuates, it doesn't change on the balance sheet because we're keeping historic cost, not current market value. Right? Same thing with all of the capital. It's historic price, historic cost, I should say. But essentially what happens is that the company has all this capital, these 5 accounts that I've highlighted, they have all this capital, and then they have to make a decision of how to use it. They take this capital and they have to make decisions about which assets to purchase with it. Generally speaking, that'll be fixed assets. Sometimes it'll bleed over into short term, but generally, basic idea, current liabilities and current assets go together, capital and fixed assets go together. Like I said, it's not always quite that clean cut, but that's the idea. So we're going to leave that investment decision of the companies about which assets to invest in. We're going to leave that later. And we're going to talk about now the investment decision for outside investors who are going to put money into the company through capital. All right. So you see there are 5 accounts, 5 capital accounts: long-term debt, preferred stock, common stock, paid in capital, and retained earnings. We're going to start with long-term debt. And that long-term debt could be any number of things. I mean, debt means borrowed money. They borrowed from the bank. They borrowed from a mortgage broker. They borrowed somewhere, and they borrowed long-term. There are lots of different things that could fall into that account. We're not going to take time to go through all the possibilities. We're going to concentrate on one category, one type of long-term debt, and that is corporate bonds. And we're going to talk what bonds are, how they work, all that sort of thing. But for now, at this point, it's enough to say that the money in that account, that 164 million right there in 2020, that 164 million, that money got there because the company sold bonds. We'll talk about what that means, but for now, the company sold bonds. Who did they sell them to? Investors. Right? They sell the bond to the investor. The investor gives the company money, and that's where that 164 million came from. Now, why did the company sell the bonds? Well, in order to raise that capital so that they can invest in assets. Which assets? We'll get there. The question for now is, why did the investor buy the bond? Well, the answer is the investor bought that bond, first of all, because the investor thought the value was greater than the price, and because the investor expected to get a return. It was a good finance word, return. In other words, the investor expects to get his or her money back plus something more, and that something more is the return. All right, so bonds. The company sold the bonds. They get cash. The investor buys the bond, gives the company cash with the expectation of getting the money back plus something more. And we'll talk about details here in a bit. Right? Preferred stock. How did that $10 million get there? Well, what happened was the company sold preferred stock. Who did they sell it to? Well, they sold it to an investor or investors. Why did the company sell the preferred stock? Well, in order to raise capital to invest in assets, generally fixed assets. Why did the investor buy the preferred stock? Well, the investor bought the preferred stock expecting to get the money back plus a return. Now, the return is different from a bond than from preferred stock, and we'll talk about that in detail. But for now, the concept. The company sold the preferred stock to raise cash. The investor bought the preferred stock and gave the company cash with the expectation of getting that money back plus a return, plus something more. Okay? All right. Now, the next 2 accounts, common stock and paid in capital. If you'll remember, those are 2 parts of the same thing. All right. In this case, the company sold common stock and the investor paid for it in cash. The question then is, what does the company do with that cash? And if you remember, common stock has a par value. The amount of the par value goes into the common stock account. Everything else goes into the paid-in capital account. Right? If they sold 10 shares of common stock that had a par value of $1 a share, and they sold it for $100. Well, 10 shares at $1 par value, that's $10. That goes into the common stock account. The other 90 goes into the paid-in capital account. Right? Those two things together are what they sold for common stock. All right, so remembering that, the company sells the common stock, receives cash. It gets divided between those two accounts, and they use it to invest in assets. The investor buys the common stock and gives the company the cash with the expectation that they will get the money back plus a return. Okay? Now, finally, retained earnings. Retained earnings is the last of the 5 capital accounts. And remember, retained earnings represents net income that was not paid out as dividends, but rather maintained to reinvest in the company. Whose money is that? Well, bottom line, retained earnings belong to the common stockholders. And remember, if you look at an income statement, we start with sales and then we take away all kinds of expenses. And one of those expenses is interest expense. Well, that gets paid to the bondholder, at least part of it. And then we get down to net income, and that net income either is paid as dividends or retained. First, we pay the preferred stockholders their dividends, and then everything else belongs to the common stockholders. Depending on all sorts of things, that leftover money, that residual could be more or less, but it belongs to the common stockholders. And the retained earnings is the amount that the common stockholders have allowed the company to keep. Why would they let the company keep their money? Why not take it all as dividends? Well, the idea is that the company keeps it, reinvests it, and generates future income. In other words, generates a return. So where does the money in the long-term debt, the corporate bond capital? Oh, I can't talk. Where does the money in the corporate bonds come from? They sold bonds, investors gave them cash. How about preferred stock? They sold preferred stock, the investor gave them cash. How about common stock? Common stock and paid in capital. They sold common stock, the investors gave them cash. Retained earnings, the common stockholders let them keep the money. All right, so there are 5 accounts in capital, and here they are in yellow. But there are only 4 sources of capital: corporate bonds, preferred stock, common stock and paid-in capital. Remember, those are 2 parts of the same thing, and retained earnings. 5 accounts, but only 4 sources, because common stock and paid-in capital are 2 parts of the same thing. There are only 3 providers of capital: the investors who buy the bonds, bondholders; the investors who buy the preferred stock, preferred stockholders; and the common stockholders that both buy the common stock and allow the company to keep the retained earnings. These three things I've highlighted in green all together we call common equity, because it's all provided by the common stockholders, either by buying stock or by allowing the company to retain earnings. It all is the common stockholders' money, and therefore it's all invested by common stockholders. 5 accounts, 4 sources, 3 providers. And those providers are bondholders, preferred stockholders, and common stockholders. Okay? What we're going to do now is, over the next 3 learning modules, is we're going to approach each of these providers of capital and talk about making that investment decision and making it from the investor's viewpoint. Right? We're going to talk about the investor comparing value to price and making that investment decision. Okay? All right. So in the next video, we'll pick up on bonds, then we'll deal with preferred stock, and then we'll deal with common stock, and that'll get us to midterm. Let me know if you have questions. Thanks.